This is a bit of a follow-up to yesterday's video, which was long and rambly, and I covered a ton of stuff because I was kind of just having diarrhea of the mouth after a week, essentially, of just discussing the Kyle Rittenhouse trial, which has consumed all of my attention. But I mentioned something late yesterday, probably somewhere well after the 30-minute mark, about a situation which I've discussed many times over the course of the channel, which is sort of the end game for America. And the end game for or I shouldn't say for America, for the United States government, for Washington, for our centralized government. That will essentially go boom whenever the next time interest rates rise. And for the purpose of yesterday's video, I kind of took for granted, although I didn't give a timetable, that interest rates would go up from the extremely low levels that they're at now to sort of more reasonable, normal levels. Like I use the example of the 10-year Treasury going from 1.5% to 5%. And I don't want to understate, for people who watched yesterday, how much of a seismic shift that would be for the 10-year Treasury to go from where it is right now, 1.57%, all the way up to 5%. Even if it doubled and went to 3%, that would be huge. But I discussed that one reason that you would see yields rise that high is to factor in what is essentially the inflation premium. If inflation goes up, interest rates have to go up to account for that, because even if people are willing to accept, and by people I mean financial institutions, people who are the main buyers of treasury bonds, foreign governments, the like, big banks, even if they're willing to accept a negative interest rate, they still factor in the rate of inflation to how negative of an interest rate they're willing to tolerate. And so there should still be a correlation in the direction and of where Treasury yields are moving and where inflation is moving. And seeing as how inflation has been substantially higher than it's been at any point in the last decade, over the course of the past year or so, you might expect Treasury yields, interest rates, to be moving up in the same direction. And when you look at Treasury yields, that's just not really been the case. They kind of are acting independently of the CPI. We're not seeing the 10-year yield or the 30-year yield, double and triple along with the rate of inflation. And so you can look at it in at least two ways, although there's probably more ways than I can think of offhand. I think that, to the layperson, the obvious explanation would be, oh, well, the bond market is not functioning for some reason, because we can all see inflation has gone up significantly, yet interest rates are not rising. And actually, I thought of a third thing, so let me put that in before the last one. Another thing that might cause this is you could say, well, the bond market is just willing to tolerate significantly more negative interest rates than they were before. So if before, let's say inflation was 2.5%, bond yield was 1.5%, you were getting at the end of the day a negative 1% yield on that investment. And let's say bond yields double from 2.5% to 5%, and did I say bond yield? I meant inflation. If inflation goes from 2.5% to 5%, and the bond yield stays at 1.5%, the real yield then went from negative 1% to negative 3.5%. And so it's possible that for some reason the bond market is just willing to tolerate more negative real yields. But what is perhaps a less intuitive explanation, but still just as plausible, the bond market is anticipating that now don't laugh, the inflation that we're seeing now actually is transitory. Now, again, this is not a narrative that I'm necessarily pushing myself. I've been torn for a long time on how exactly the degradation and the unwinding of the current economic bubble is going to happen. Whether or not we would see high inflation or not is, I don't want to say above my pay grade, but it's something that I've been in a wait-and-see approach on. And some might say, well, we're seeing inflation start to pick up and rise pretty significantly, although nothing like the 1970s yet. So we're probably going to, the inflation's probably going to keep rising, and we're going to go into a period like the 70s of stagflation, where we have a depressed economy and everything is really expensive, and it really just sucks to be alive. But I'm not to that point yet. I don't see why that's necessarily more likely than a repeat of the 2008 situation. Something that, people like me who have been, let's say, doubtful about the underlying strength of the U.S. economy for many years, something that we have pointed out is that the 2008 crash was essentially frozen in time. It was not allowed to really finish itself and purge all of the toxic waste that was, all that poison that was ailing the body known as the U.S. and the global economy. So my base case for how this current bubble unwinds is that the crash of 2008, which has been on pause for over a decade now, essentially just resumes. And I would think we would go into a period more like that. Stagflation in the 1970s, that was quite different from what we experienced back in 2008. And if you look at the rate of inflation, inflation was on the uptick prior to the 2008 crash. It was going up at a good pace, and it was accelerating. It was going higher and higher. It got up to 5.5%, I think, at the peak. That might be quarterly. I don't know if that's quarterly or monthly. I can't remember which chart I was looking at, but it was somewhere in the fives. I recall that. And so we're kind of in that range now, even if we're a little above it, even if we get into the sixes. We're not out of the realm of where we were back in 2008. And as we know now, after that peak, that was essentially like a blow off top. And in the next year, consumer price inflation came crashing down. Now, that doesn't mean that it was transitory in the sense that all those prices that went up came back down. That's not what happens. It's the rate of increasing. So yes, all those price increases from back then, when you see all that inflation on the chart, that's locked in. Prices are still higher. It's just they stopped going up at such a high rate. So I'm not saying that's something to be happy about, but it's better than stagflation in the 1970s, where you had, high single-digit to double-digit inflation year after year after year for a decade. And so this brings me back to the bond market. The bond market in the 1970s was no man's land. Nobody wanted to buy bonds. Bonds were a terrible investment. Everyone knew you want to go out and buy U.S. government bonds. Why don't you just take your money out of your wallet, strike a match, and set it on fire? At least then, you can get some warmth out of it. You can start a bonfire. You can heat your home, because that's better than what you'll get just losing your money by buying U.S. Treasury bonds. Yields were high, but they were not as high as inflation. And the value of bonds on the open market was quite low. Now we see quite the opposite. Yields are absurdly low, and bond prices are ridiculously high. And this inflation that we're seeing right now hasn't changed that. And if there is one segment of the financial system that I think is actually forward-looking, it would be the bond market. I think that the people involved in the stock market are a bunch of buffoons. People who look at the stock market as a, as a forward indicator of anything, are a bunch of buffoons. But the bond market is still, the people involved with it, people who buy them, I still have respect for their intelligence. And as Jeff Snyder and Emil Kalinowski pointed out, I can't remember, I think, gosh, did they put this up today or yesterday? I was listening to part of it. I was listening to a lot of people because I'm trying to get back and get my, with all the Rittenhouse stuff, I'm trying to get back into finance a little bit to detox from all of this legal stuff, although I still have the end of the Rittenhouse to go at the end of this next week, and I'll be talking about that. But I'm trying to get caught up on what I've been missing in finance. And those two were pointing out about how back in 2008, remember what I was saying about inflation? Inflation, what we're seeing from inflation right now, it's not really out of the realm of what we saw back in the the pre-08 crash era. Likewise, back then, even though inflation was high, the bond yields were stubbornly low. So Snyder and Kalinowski, who are very intelligent guys, I have a lot of respect for them. You could go subscribe over to on Emil Kalinowski's YouTube channel. He deserves a lot more subs than he has. I would tend to think that, from what I've seen, I'm not going to come out and say that they're 100% right in their position. I don't know that yet. We could still go into a 1970s style of stagflation, which I think would be the fastest road to the end of the U.S. government. If that happens, the U.S. government's screwed. The U.S. cannot endure another 1970s style decade. I don't think they can endure 2 or 3 years of it. But at this point, it is just as likely, if not more likely, considering that I think that we have much more in common. Our current situation has much more in common with the pre-2008 situation than it does the late 60s, early 70s situation. And so if bond yields are remaining stubbornly low, as they did pre-08, I would say that's a pretty darn good indicator that the inflation that we're seeing now is not going to go on for the next decade. It's not going to go on until another Paul Volcker comes around to wring inflation out of the economy by raising interest rates. And if that were the case, again, if that were the case, we would really, really be screwed. Because there's going to be no Paul Volckers being nominated to be the chairman of the Federal Reserve anytime soon. Jerome Powell will not raise interest rates. I will stand by that, and I will apologize if I'm wrong, but I've said that ever since he flip-flopped back at the start of what should have been the crash of 2018 to 2019. That was when things started to come unwinding, and we didn't see super high inflation and high bond yields back then. We saw very low bond yields. I still maintain, I said it back then, pretty sure I had this, well, I started this channel at the start of 2019. So it was after the Christmas Eve massacre, and it was after the fall of 2018, which was really, when you could feel everything coming apart. What we're going to see is probably going to look like 2018, because the Fed barely staved that off, and so I don't think we're going to go from 2018 back to 1972. We're probably, at this rate, going to slide back into a 2018 start to a crisis, which is going to lead into a 2008 style crisis. I don't think that the bond market would be this caught off guard by stagflation. It's been long enough. It's had enough time to react. And typically I would think that the bond market would forecast something like this. I don't think that it would take 6 months for the bond market to catch up. The fact that the bond market has not really priced in a bunch of inflation, to me, is still a sign that this is not going to last. And by not going to last, I mean not for a decade. We had relatively high inflation above 2%, for a couple of years, I think at least, before the '08 crash. And yet bond yields were still quite low. The reason for that probably has something to do with pricing and risk, to the stock market. People who didn't want to be in stocks and saw there was a ton of risk in the stock market that obviously was there. That risk happened. So it's not a question at this point. It's not speculation. There was a stock market crash, and the people who were moving their money into bonds in the year or two leading up to that crash preserved a lot more of their wealth despite the inflation. I'd rather pay negative interest rate for or get paid a negative interest rate for 2 years. Let's say you lose 4% a year, you're down 8% total. That's not great, but it's better than losing 50% in the stock market. That's essentially the thinking and the behavior that you're seeing in bond prices, or at least that's kind of what it appears. I'm a layman, so I can't. I'm not going. I don't give financial advice. So what I'm trying to say is, don't count your chickens when it comes to stagflation, or certainly hyperinflation. We're nowhere near hyperinflation. So with that said, I'm going to try and get myself back, get my brain back more into finance mode, because I do miss following this stuff, and I'm sure there's been a lot that I've been missing lately. And then, of course, we've got Rittenhouse coming up at the start of this week. I guess we'd probably expect a verdict around Tuesday, like Wednesday at the latest, I think. So with that said, I will see you folks back here tomorrow.